Have you ever heard about forex trading and you are confused that what are they even trading? How are they making money from this market? What is the hype about? And you want to know more? Well, you are in the right place because everything behind me here is the fundamental of forex trading. This video is for complete beginner. You've never traded before, you've never placed a trade before. You're just curious, want to know what forex trading is about. Just sit down and take a cup of matcha because in this video I'm going to be explaining what forex trading is, what can be traded, and how people make money from the forex markets. I am going to be moving away from the screen now if you want to screenshot it, because I am going to be zooming in to explain everything one after the other. The first question is, what is forex trading? Forex trading is basically exchanging of currency. If you have naira now, you want to exchange it to pounds, or someone sent you dollar, you want to exchange it back to your base currency, you have simply participated in forex trading. The only difference is that traders like us, we trade it on platforms like maybe your broker platform, where we sell or buy because we believe price will go up or down just for us to make profit. That's just the difference. Believe me, almost everybody has participated in trading forex in one way or the other. Why do people trade forex? Number one, for profit opportunity, right? Number two, hedging. The banks, the hedge fund, they trade forex to protect their money. For international businesses, for example, people that buy markets from China, they change their money to China currency. That's just forex. And another reason is investing. People invest in currency. For example, there are so many people in Africa that are investing in dollars. So that's another reason why people invest in forex trading. What can be traded in forex market? So many people think that you can only trade money, you can only trade currency in the market. But no, there are so many other things that can be traded as a trader depending on your broker. For example, you can trade forex, like I'm saying, you can trade currency. For example, you can trade Euro USD, GBP USD, which is pounds USD, GBP JPY, which is pounds versus Japanese yen. And you can also trade metals like gold, silver, copper, etc. like that. You can trade indices like NAS 100, S&P 500, US 30, German 40, all those US stock markets. You can trade them in the market as well. You can trade oil. You can trade UK oil, US oil. Those are the oil commodities. You can trade them, and you can trade your cryptocurrency as well. You can trade your BTC, your Ethereum, and all those things in the market as well. When we just want to say, you just say I trade forex, it doesn't mean that the only thing we trade is currency. If you understand all those things as well, if you understand how they move, you've done your analysis on them, you can as well trade them in the market and make some profit. Understanding currency pairs. When you hear Euro USD, what comes to your mind? It simply means the price of one euro at that time equals to 1.1700 USD at the time you are looking at it on your chart. For example, you just open your chart like this and your line is on. You just open your, for example, maybe USD card chart, and your line is on 1.4085, something like that. That means the amount of USD equals to of 1 USD equals to that price in Canadian dollar. That's how it works. When you hear Euro USD and you see it on the chart and you see the number, just convert it in your head that this is the price, this so pair, this so currency worth in the pair. Now let's talk about types of currency. We have three major types of currency pairs. We have major pairs, we have the minor pairs, and we have the exotic pairs. Major pairs are the most traded currency pairs everywhere in the world. For example, Euro USD, GBP USD, because they are well traded, they have a lot of liquidity. Then we have the minor pairs like Euro GBP, UD JPY. Those are the minor pairs. You can still trade them. And we have the exotic pairs. You can still trade them but they have low liquidity compared to the major pairs. Then we have the exotic pairs. Those are the pairs of maybe like developing countries. For example, USD, NGN, USD, SGD, all those developing country currency. As a beginner, it is advisable to always start with major currency, because they have, like I said, they have a lot of liquidity, and they have low spread. The forex markets open 24 hours a day, 5 days a week, which give you the opportunity to trade this anywhere you are in the world. And they are divided into 4 sections. We have the Sydney section, the Tokyo section, London section, and the New York section. Buy versus sell. What comes to your mind? It simply means when price is going up, we buy, and when price is going down, we sell. You can also say, I want to long Euro USD, or I want to short Euro USD. It simply means I want to buy Euro USD, or I want to sell Euro USD. Just think that when somebody is saying that I want to buy, just know that maybe the price is going up. And when the person say I want to sell, it simply means the price is going down. Basic trading terms. When you hear pips, what does it mean? It means the smallest price movement of currency pair. Like when your price move from, maybe you move from 1 to 2, that's 1 pip. The way price are moving on the chart, like one pip, 2 pip, 3 pip. That's what pip simply means. Spread is the difference between the buy and the sell price. When you place a trade, the broker has a way of calculating the spread. It's just the difference between the price movements. And lot size. Lot size simply means the amount of the currency you want to buy. When you go deeper, you understand that one. Like maybe you want to place a trade and you say maybe 1 lot size or 2 lot size or 0.01, or those are the lot size. Leverage simply allow you to trade large capital with small amount of money. I will explain it deeper later. Margin is the money required for you to open a trade, and stop loss is the level where you put your trade that invalidates your trade. Take profit is the level where you target that you want to take your profit, that when the price gets to this so stage, I'm going to take my money out of the market. A pip is the smallest unit of price movement. For example, you open your chart and you see those numbers from 1700 to 101, that's 1 pip. From here to here, that's 2 pip. From here to here, that's 3 pips. That's movement of 1 digit of 0.000 is 1 pip in the market. Leverage allow you to control a large portion with small amount of money. For example, you put $10 inside your broker, and if you put $10 inside your broker and the broker gave you like 1:100 leverage, you'll be able to control a $100 amount of that currency. If you put $100 in your broker and the broker give you 1:100 leverage, you'll be able to control $1,000 amount of the currency you want to trade. That's simply what leverage means, as if they are borrowing you money. Sometimes it allows you to make more profit, but at the same time it is risky because it exposes you to more risk in the market. What is the process of taking a trade? It's just simply 5 process. You take your trading view, you analyze the market. After learning about your strategy and all, you analyze the market, you check and you find a setup. After that, you place your trade, you manage your risk, and you take your profits or you take your loss. That's simply how it works. You take your trading view, you analyze the market, you look for a setup. After finding a setup, you place your trade. After placing your trade, you manage your risk. That's important. After that, it's either you take a profit or you take a loss. That's it. Simple as that. This is an example of how a trade looks like. Maybe after analyzing, this is your setup. What you need to do is to place your trade. You put, maybe your setup says, your analysis says you should buy. The only thing you have to do is to place your entry, place your stop loss at where you know that if this thing comes, hits my stop loss, I am wrong. Then you put your take profit at a reasonable place where you'll be able to take the double of the money you risk to enter the trade. You get? So this is an example of how a trade look like. Maybe after analyzing your trade, it says you should buy. Your setup asks you to buy. Your setup asks you to go long. You find your entry, you place your trade. For example, this is your entry where you place your trade. You are going to put your stop loss. After managing your risk, you've known the amount that you want to risk for that trade. You are going to place your stop loss at a reasonable place that when the price comes back and hits your stop loss, you know that the trade is being invalidated, and you put your take profits where it is reasonable, where you be able to make at least twice of the money that you are risking on that trade. This is simply how it looks like when you place a trade. If you notice, I have been emphasizing on risk management since I've started this video, because as a successful trader, if you want to be successful in trading this market, you need to learn how to manage your risk properly. So those are the criteria of how you manage your risk. You risk more amount of money, protect your money, let your profits run. Okay, maybe all the money you have is $1,000 and you go all in one time. No, that's not a good risk management. If you know that you have like $1,000 and you are okay with losing $100 at a time, or you are okay with losing $10, you think about it. Is this thing going to affect me if I lose? Because you never can tell. The trade can go wrong. The second trade can also go wrong as well. How are you going to feel? Consistency beats perfection. Nobody is perfect in this market. We are all just trying to make ends meet. But the only thing that is keeping us alive, or that is keeping us in the game, is risk management, because you will take losses. I am not going to sugarcoat that. You are going to take losses. Risk 1 or 2% of your account. Always use stop loss. Always use stop loss. Never risk what you cannot afford. Like I said, risk management is subjective. It depends on how much you can risk as a person, how much risk you can take as a person. Let's look, for example, I have $1,000, you have $1,000. I can risk $100 from my $1,000 without it messing with my head. But you cannot risk more than $10 from your $1,000, because if you lose $100 at once, it's going to affect your head. Why not just stick to that your $10 and grow it, and let me that can risk $1,000 do what I want to do with my money? We are two different people. The way people can take risk is different. That's why some people are making it big in this industry. They can risk, they can take risk. While some people are still where they are and they are comfortable with it and they are okay with it and they are profitable, but they are controlling their risk. It's demo and live account. Demo account is an account that you can open with your broker. It's a virtual money, it's not a real money. You can open it and use it to try your strategy, to test your strategy. Maybe your strategy is working, because as a beginner, I would not advise you to put real money at first, because if you start losing real money as a beginner, it might be kind of discouraging. But it is always advisable to open a demo account at first and try practicing your strategy on it. Any money you risk on the demo account, it's not real money. Any money you make, it's not real money. Any money you lose, it's not real money. And there is live account. When you are now confident, you can now open a live account with your broker where you put real money, real emotions, and real results. Any money you make from a live account, it's yours. Any money you lose, it's your loss as well. Common mistake a beginner makes. I will not even lie to you. You are going to make those mistakes. Everybody makes those mistakes, but it is better you know about it. So when you start making them, you know that okay, it's a common mistake and you need to adjust and quickly, because the longer you take here, the longer it takes you to be non-profitable. Number one, you overtrade, you will revenge trading, you will not use stop loss. You will not use stop loss. Sometimes you will think you are wiser than the market and you will still not use stop loss. You use too much leverage. Like you will see, you just go online one day and you see somebody that will say, hey, I just flipped this $10 to $2,000, and that thing will now push you. You go to your account to put some money and you over leverage and you will lose your money. You follow random signal, then you start jumping from one place to another. You see this person, he say buy gold now, and you see another person that will say sell gold now. Then you start jumping, start placing different trade. You are going to lose your money. Expecting to get rich quick. Oh, then you go online, you see somebody that say, I just bought a Lamborghini. And you'll be like, oh, I've been trading this market for the past 3 months. I've been trading. Why am I not making money? Then you start losing more money. If you don't want to go through all this, or after going through all this, you still want a way forward, you have to learn how to be patient. You stay disciplined, you control your emotions. You know, if you're a kind of person that does not take nonsense, you have to talk back. In real life, you have to always talk back. You can't control your emotion. You can't just keep quiet. You have to do your own back. Focus on the process, not the money. Learn and improve daily. I forget to add this: journal, 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 journal all your trades. And have you ever wondered what makes the markets move? Like, the money is just going up and down every time. It's going up and down. What is even making it move? What is moving it? Why is one currency higher than one at this time, and the next time the other one is higher than the other one? Like this week now, maybe GBP is buying against US dollar, and the other week US dollar is trending low. What do you think is moving the market? I'll tell you: economic news, interest rates, inflation, political events, market sentiment, inflation, all those things that are happening. Those are the things that are moving the market. Now, let's jump into time frame. Time frame is what you see on your trading view. You see them on your trading view. When you start analyzing your strategy, you will know how to work with time frame. There are different time frames on trading view. It depends on the kind of trader you are. That's the type of time frame you'll be working with. If you are a swing trader, you probably lean more to higher time frames like daily, 4 hour, 1 hour. If you are a day trader, you probably lean more into 1 hour, 15 minutes, 30 minutes. And if you are a scalper, you probably lean more into 5 minutes, 1 minute, and those lower time frame. But when you get to your trading view, when you start learning more about your strategy, you understand all what those time frame really means. You keep hearing trend is your friend, trend is your friend. There's what they call uptrend, and there's what they call downtrend, and there's what they call sideways trend. Uptrend is when the market is going up, downtrend is when the market is going down, and sideways is when the market is going up and down. We call it consolidation. So when market is moving up and down, and like you cannot see a clear trend, that's what we call consolidation, or you call it sideways trend. When you hear volatility simply means how much price move in a period of time. Like if you hear this market have a high volatility, it simply means there are big moves in the market, like there are a lot of opportunity in the market. And when you hear low volatility, it simply means the market is moving slowly. So, and it's always okay to trade the markets when the volatility is high, because you'll be able to see a quick move, and your trade will be able to hit a big profit or stop loss quickly. News trading: this is the time where big moves happen in the market, especially when we have red folder news. That's when we have high volatility in the market. There are some people that only trade news. They work with fundamentals. So they only trade fundamentals. They understand what's going on in the country. So that's what they used to trade. Then building a plan. When you get to that stage, you understand your strategy. You will now make a plan for yourself from everything you have learned. You will define your strategy. You know when to enter the market and when to stay back. You know how to manage your risk, and then you start seeing improvement. Journal. Always journal your trades. Track every trade. That will make you to know where you are falling short and what you need to improve. And you keep learning. We keep learning every time, because learning does not end.